What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Charlie, Annie and Ben with you today, talking through the weekly wrap-up of the news, what we've been up to. How's your week been, gents?
Yeah, it's been another good week. Plenty of news going on. And we had Better Business in Sydney this week.
Better Business still going on. It was your first time attending Better Business, Charlie. What do you think?
It was great. It was good to meet all the brokers out there and the lenders as well, and you know, put faces to names that we're writing about on a daily basis. That's always nice.
Yeah, I think
real people.
Similarly, through a lot of the brokers who came to the summit, they're like, "Oh, cool! These are the people who actually like you see the bylines from." And being like, "Oh, wow!" But yeah, lots of interesting brokers that came along. And thank you to everyone who came. It was packed actually at the Sydney event.
It was a good turnout.
Loads of people really engaged and interested in hearing about AI and how they can be using it, how they're scaling their businesses. I think like a lot of people really enjoyed the content. So looking forward to taking it to the summit to Melbourne next week, which is the final stage in the roadshow. But of course, not just the summit, also the awards as well, which we had last night. So that was really fun at the Hyatt Regency in Sydney, being able to celebrate the leading lights of both New South Wales and ACT. Quite a few ACT brokers made the trip over, which we appreciated.
Nice.
Always great to celebrate in partnership with NAB all of the success of the broker channel in our home state, which, well, the advisor's home state, which we really appreciate. So it's good fun. Little bit, tiring, long day,
days.
long night.
Yeah, days,
yeah, it's a big day, I think, but
huge day.
A lot of information to soak up as well, but all very interesting nonetheless and pertinent.
Yeah, but so we had, I think, 22 categories at the awards, including the Editor's Choice Award, which is a really fun one that I get to present to a broker of my choice. And for New South Wales, it went to Kirsty McKinnon from Flair Finance. And bless, I always feel slightly guilty about the Editor's Choice one because you don't know it's coming. So it's always at the end of the night. People have kind of relaxed, they've eaten their food, they're just sort of chilling out, and they hear their name and they're like, oh my goodness. Yeah. And they kind of have to scramble to make a speech. So I do feel a bit guilty about that, but it's such a lovely privilege to be able to select someone to champion. She's been doing an amazing job over in Dubbo. With her brokerage over there. So yeah, it was really fun to be able to celebrate her. And then of course, the Broker of the Year, which always goes to the highest scoring winner from the broker categories, the top broker categories on that night. So again, you also don't know who's going to take that one out because it's basically just looks at all the big broker categories. So I think it's best resi broker, best commercial broker, maybe best customer service individual. Can't remember the categories all off by heart, but the big ones. And then they look at the judges' scores from each of those winners and then say who got the highest score. And so this year, it was a Mortgage Choice Warners Bay broker in the form of Christy Gould, who we've actually had on the podcast before.
Nice.
And again, so lovely to celebrate brokers and hear, in their acceptance speeches, like who they're thanking and what they've been doing. And if you haven't already listened to the podcast with Christy, then I'll put it in the show notes actually, so you can have a little listen about what she's been doing. But Broker of the Year, New South Wales ACT, so that's exciting. So next week, travelling on to Melbourne.
yeah, one more to go.
One more to go. And I think at the end of it, my liver will fall out.
I was about to say it's gone by quickly, but I think you might.
It has gone by quickly, actually. But, I think I feel so old whenever I say it, but I'm like, I cannot believe we're in April. And by the time we do
I'm with you on that.
Better Business next week, it will be mid-April.
Yeah,
so,
scary.
Accelerating
Very scary.
Accelerating by. But, I think all the things that were sort of going on as well, like headline-wise, even at the summit, we were hearing lots of stories and people telling us stuff. And one big thing that broke yesterday was the Deposit Assure acquisition. Deposit Power was at the event yesterday, so I was having a good old chat with them about it. Charlie, you actually wrote this story though, so give us the deets. What happened?
I did. So yeah, it's a pretty big deal. Two of the biggest players in the industry, Deposit Power, which is part of Credit Group, announced yesterday that it had moved to acquire Deposit Assure. So this tie-up, Deposit Power has said, is going to create the country's largest deposit bond provider.
They were pretty much, I think, two of really the only players doing it.
So they've now kind of merged to become the kind of all-encompassing player in the market. And they've put the acquisition down to a couple of things. First, they've kind of said that, it'll add scale and expertise, but also it'll enable continued investment in systems and processes aimed at issuing deposit bonds more quickly and reliable. They kind of stress that. And also they were talking about market conditions as well, that the accelerating demand for this, as well as kind of conditions are tightening and people are looking for other ways to kind of move in on a deal quicker as well. They've linked it to current property conditions and demand for reliable non-cash options, which has been heating up and intensifying.
And I guess this always goes with the affordability conversation we've been having really for the last probably 10 years about, how people are kind of trying to get into the property market, how they're affording, to actually sort of circumnavigate the whole process of getting onto market, saving for a deposit, and deposit bond has been quite a popular tool. So interesting to see that acquisition. So it's both staff and, I guess, companies. So the whole thing that they've been bought. I think the idea is that they'll continue until I think it's the 1st of May is the turnover date when the branding will rechange and everything. So they've got a few weeks to bed it all down. Yeah,
they've called it a defined transition period, and that in that time period, the two merged entities would work together to maintain existing processes and relationships with the two brands expected to coexist until the deal is completed, which, is going to be early May, which you just said. And they've said that that's subject to customary condition and kind of regulatory approvals and whatnot. But once it's completed, it'll see Deposit Power come as the Deposit Power emerge as the major player in the field, really.
It'd be interesting to see if more and more people sort of start to look at mechanisms like deposit bonds and that kind of thing to get into the property ladder. I actually talked to Nick Rumpf, who is the head of sales and distribution at Deposit Power, for a podcast which will be coming out later this month, I think on the 22nd, And we really unpacked like all sorts of different use cases for it, how it could work for investors, first-home buyers. It's all that sort of taking the stress out of a simultaneous settlement, which there are a few different types of ways to do it, but deposit bonds are one of those mechanisms.
Yeah. I felt like yesterday all we were talking about were deposit bonds.
Yeah.
Well, it was a good crash course for me as well. I heard Ben talking about it a week or so ago when he did the podcast. I was kind of scratching my head, but I think I understand it now, and it's a fascinating topic.
We're gonna take a quick break here. When we come back, we'll find out what else we've been talking about, including lots of stuff around how we can be mitigating fraud in the mortgage and home lending landscape, and some suggestions on how to do that. We'll get into that just after this. So this week, there was some interesting moves from some of the finance associations as they wrote a letter to the Treasurer, Jim Chalmers, asking, not really asking, just suggesting that maybe open banking should be tweaked to include things like ATO data. Now, we've been talking about open banking and how it can be improving the mortgage landscape for years. And I think like really the big thing that seems to be holding people back has been like either it's, consumer engagement, so people just not being aware of it or not using it, not being sure of it. And I think the major frustration that a lot of people in the broking industry at least have is being like, it's such a good system if it would be used. But also being like, but there are elements that could be improved. And so because of, I think, the last few weeks we've been talking about home loan fraud in, with AI documentation, for example, there's been a lot of concentration on, well, what can we be doing to try and mitigate some of this? And of course, there has been a lot of conversations across the finance industry. And so several finance bodies, including the Mortgage and Finance Association of Australia, there's also the Australian Banking Association, FinTech Australia, I think it was COBA, and the Australian Finance Industry Association penned a joint letter. I think actually the ABA wrote it and they had co-signatories to the Treasurer saying, well, we should actually be looking at expanding the consumer data rights so that it does include things like tax returns, but also things like asset company registry data so that we can ensure that people's incomes, for example, are what they say they are. They're not, creating fraudulent payslips, for example, or bank statements,
Yeah.
but also that if they're taking out a loan for a business, that they actually are a genuine bona fide business
Yep.
and that they're sort of registered that way. So I think this is all like really great recommendations. It makes sense to me. After all, the ATO portal is so brilliant. As a foreigner, you don't understand how tedious it is in other countries to do your tax return. So being able to log into a portal and be like, oh, it's all done.
Yeah.
Amazing. So
Very
I think
handy.
like having the ability to have just some like this open banking platform tap into ATO data like
Yeah.
it does with many other different things already,
Yeah.
like your banking data, makes sense to me. But the bigger question is, how do you do that with all the laws that are currently in place around sharing tax return data, because there's a lot of privacy rules in place. So I think just needs a couple of tweaks and then that could work. What do you guys think? Would you be open for your tax return data being used in open banking if you were going to use open banking?
It's a very good question. And I guess that's one of the hard parts, the consumer piece, sort of getting the consumers to buy into it. And
Yep.
because, it's a no-brainer for lenders and industry groups like mortgage brokers. You can sort of really see the advantages. But I guess getting that level of trust from consumers is a little bit harder, I suppose.
Yeah.
That's a good question. I don't know.
Would you be comfortable? How about you, Charlie? Would you be comfortable having your tax return information being pulled
Yeah.
using open banking?
Well, I had this. I had a bit of a. I interviewed Corey Smith a couple of weeks ago he's a senior partner at FICO, and he spoke about industry needing to lobby the ATO to have direct APIs as a single source of truth. And he we interview wrapped up and he's like, well, how do you feel about it? Where do you sit? And I said, well, look, if it's going to, reduce, my banks being undermined, then absolutely. Because you need a credible and reliable system. And, the ATO is already plugs into people's bank accounts anyway.
Yeah.
So
You need a point of truth, I suppose. I'm also probably on some sort of tax fraud watch list
Yeah.
after that podcast comment.
maybe I got pinged. But yeah, I'd be entirely comfortable with it.
I think, and I think some brokers are like, oh, well, because a lot of the problems they have is kind of like how lenders treat income, especially if you have things like, short-term incentives or bonuses. It's kind of always, they're like, well, how do you actually treat this?
Yeah.
So I think just having a single source of truth to be like, this is what your income was. It doesn't matter how it's structured.
Yeah.
Like, I think that could be potentially more helpful. But yeah, I think having, in my mind at least, it makes sense. I do see though, the consumer element would really need to improve because already people are weird about open banking.
Yeah.
And I think it's not being talked about in enough really by the government. It's a government scheme. It's government backed. They have obviously tight security controls.
Yeah.
As far as I'm aware, the data's not really stored anywhere. It's just sort of pulled and then put into a thing. So I think it should work, but doesn't seem to. And I think consumers are still a bit unsure of, firstly, what it is, how it's being used. But it should crack down on people doing the wrong thing.
Yeah.
Because if your tax return is legitimately true, then surely, as of course everyone's is, then surely it would make the whole process of, the lending process much easier and hopefully faster.
Yeah. Expedite the process as well.
And I think this is, again, like, it's always interesting. I think some people are kind of saying, oh, maybe, they're just taking this opportunity to talk about it and tie it to mortgage fraud because we've been talking about it so much. But really, they just want open banking to use ATO data because they're lenders at the end of the day and they want to make their lives easier. But yeah, I think it's a good idea. But that wasn't the only thing we were talking about this week in terms of home loan fraud. We also heard from Austrac this week because they've been apparently writing to the lenders to be like, watch out.
What's going on?
Yeah.
Yes, and doing a kind of broad scale assessment on fraud in the industry. So yeah, we at the Advisor heard we got a comment from Austrac CEO Brendan Thomas this week, who basically confirmed that the watchdog was indeed kind of investigating and assessing, in the process of assessing how extensive this mortgage fraud issue was across the industry, and obviously comes after reports that CBA has been victim to alleged $1 billion or more of,
And not just CBA, supposedly
and
some of the other major banks too.
other major banks as well, but CBA kind of more recently. And yeah, he kind of said that lenders should prioritize shutting down mortgage-based money laundering schemes. The starting point for shutting down mortgage-based money laundering schemes was tougher scrutiny at every point of the origination chain. So he said, quote, when every professional involved in a transaction is required to know who they are dealing with and question the source of funds, it becomes significantly harder for false documents, synthetic identities, or illicit money to move undetected. He said, and he kind of spoke about Austrac's role in preventing this and the work that they're doing with the Fintel Alliance, which basically brings together Austrac, the top 10 lenders, other kind of law enforcement agencies, and also like payment companies as well to channel intelligence on the issue. And he said through our public-private partnership, Fintel Alliance, Austrac is engaging with law enforcement and the top 10 banks with data sharing underway to build a clear, intelligent picture of mortgage fraud risk. And he said that the Alliance was already in the process of sharing that data to detect these patterns that kind of individual banks could have passed over or overlooked or lost in the process. And that they're drawing on information from these banks and federal and state agencies to build a kind of overarching view of the threat. And he said, we are closely working with our partners to bring together relevant intelligence. And this kind of comes after reports in mid-March that Austrac was using information given to it by CBA to hunt for weaknesses in banks' AML systems to identify common control failures.
Yeah. I mean, these are like two slightly separate things, I think, because like mortgage fraud is obviously across the board a problem. Like, and it has fraud in money has always been a problem, pretty much from biblical times. So like just making sure that people aren't lying to get money or like trying to commit fraud to benefit. But I think the bigger problem here is not just saying we want to know the scale of mortgage fraud, but also being like people lying who are criminals.
Yeah.
So kind of being like, you know, is the money that you're giving your client or your customer going to someone for nefarious purposes? So is it to finance terrorism, for example? Or is it because, you know, they are in child trafficking? Like, what is it? Who are these people? And this is why know your client rules are so important, both for brokers and for lenders. You should know your clients.
And how's it slipping through the cracks? Wasn't they saying it was sort of income documents doctored with artificial intelligence and that kind of thing?
Yeah, so they're saying, well, for this specific, I think, most recent sort of mortgage fraud that we've been looking at has been, the concerns have been around basically lenders providing loans to people that they were thinking were genuine, and because of doctored documents, so AI generated documents, and kind of saying, I mean, we don't really have the details on it because the investigations are still ongoing, but from what ASIC was saying when they fronted one of the parliamentary committees a couple of weeks ago, they were saying, you know, there were concerns about money going to finance terrorism and child trafficking and prostitution. So I think it's really like not just normal mortgage fraud where people are just trying to get a bit of extra money to buy their house, but really being like, where is this money going and who is it being lent to? So know your client KYC laws do already exist, but it seems that maybe people haven't been interrogating them as closely as they should be, particularly when it comes to just relying on documentation. It kind of blows my mind though that people are still relying on documentation for, like, you know, the pay slips and bank statements.
Yeah, it's wild. Like legacy checks. It's pretty
just
insane.
like, surely there's a better system. Like, we have so much technology now. We have so many things. Like, how is this still what we're doing? And you know, that's just the mortgages. Look at commercial; it doesn't barely even digitize in the commercial space. So they're like really far behind. I think like, you know, and the ASIC registry thing as well, being like, well, looking at ASIC company registries and kind of ensuring that these companies are genuine companies and not shell companies. They haven't been set up, you know, 2 days ago. So I think it's definitely worth a look. But, you know, we were talking earlier today, Charlie, about the fact that it isn't a problem that's isolated to Australia. We did see a report, was it from Equifax? Who has done, looked at globally sort of what are the trends in lending, and they've said that they've identified there's a lot of mortgage fraud happening in Canada as well. So I think this globally, and the UK too is having similar issues. So I think globally, obviously, as AI starts disrupting everything, people having to tackle new challenges, and this is one of them. Being like, you know, criminals will always find a great way of coming up with new ways of getting to what they want. So it's kind of being like, well, let's make sure that all of our systems and processes can accelerate with them to stop them.
Yep. And he did kind of point out, it was remiss of me to not note that, but he basically said the review, one of the chief purposes of it was to understand how sophisticated mortgage fraud had become through these kind of falsified income documents that are allegedly being used to wash criminal proceeds as well. So, that's what they're looking at.
Yeah, that's what they're looking at. Well, it's fascinating for us, I mean, as journalists, to be able to look at this and see what's happening. But yeah, I'm looking forward to seeing some actual action coming out of it and some more detail, because the problem we have whenever police investigations are ongoing is that we don't get told anything. So we're like, can someone please talk to us?
They can go on for very long times as well.
So we'll see. But anyway, when we come back, we'll be chatting about what's happening from the compensation scheme of last resort, some big changes coming down the track that way, and we'll get into that just after this. So this week I had the pleasure of reading not one, not two, but 3 separate consultation documents on the compensation scheme of last resort, CSLR, which was released by the Assistant Treasurer and Financial Services Minister, Daniel Molino. And okay, this is going to be a long one, but I'm going to try and unpack this briefly. Basically, as many people obviously will know, the CSLR has been not, should we say, doing the best in terms of funding. So compensation scheme of last resort basically gives consumers who have complained to AFCA and received some sort of agreement that they should be compensated for a financial service that went wrong. If their company, for example, has gone bankrupt but then haven't received payment, they can then get compensation from the compensation scheme of last resort. But because in the financial advice industry, there have been so many collapses the last few years, the compensation that has been given to consumers has gone up dramatically. So much so that basically the kind of budget, the limits that they put in place for the financial industry to pay to cover the cost of this levy, blown out of the water. So if we look at just, for this coming financial year, for example, normally there's a maximum levy of $20 million that can be applied to each of the sectors that have to pay money into this scheme.
Yep.
But because of the collapse of so many of these big financial advice companies, they needed an extra $47 million this year. And for FY27, that's blowing out to $106.8 million above what is already looking into it. But that doesn't even include some of the actual costs of the collapses. So if you actually include the collapses of things like Shield and First Guardian, for example, the revised estimate for FY27 means that the personal financial advice funding cost would be over $250 million. So this is a lot of money we're talking about.
Yeah.
And lots of the questions that have been raised by people in the industry have been like, well, what exactly are we giving compensation for? And I think one of the big arguments has been like, well, some people in the financial advice industry were receiving compensation for basically investments gone wrong. So being like, we want the money that we would have got if we'd invested properly. If this company hadn't collapsed, for example. And so kind of being compensated for that. But a lot of people are saying that is not what the scheme is for. It's not to give you returns that you were expecting. It's to actually say something has gone wrong, here's some compensation. So lots of recommendations over the last few years. There have been loads of inquiries and consultations on how we can improving the CSLR because this doesn't seem feasible. These costs can't keep blowing out like this. So they released 3 separate consultations this week, one of which is about how are we going to fund this, because we can't keep adding on these levies to the financial services industry, until ad infinitum. So it's sort of being like, well, what are the limits? We already have these caps in place. They've already been blown out, and we need to be doing something to actually fix it. So they put forward 8 recommendations in the consultation that's just about looking at really the funding for it. One of them is deducting payments from consultations. So this will basically say the CSLR can deduct amounts a claimant may receive from other sources. So for example, such as class action settlements or insurance payouts. So they don't they're not making money. Because if you've got, a payout from a class action or something, you've been compensated.
Yeah, yeah, no, that makes
So it's
sense.
kind of saying, well, we shouldn't be then paying them again.
Yeah.
So that makes sense to me. They're also saying they want to strengthen the CSLR's power to step into the shoes of the claimants to pursue wrongdoers. So, for example, they can claim against the professional indemnity insurers of failed firms and extend recovery rights to individual partnership members, not just large corporations. Again, I think that's sensible. They've got some sort of technical fixes as well. So being like, if you... I think at the moment they don't allow compensation to be split across multiple bank accounts, which is problematic. For example, if a couple had a loan that went wrong, they're seeking compensation, but then they divorce, only one bank account can be paid.
Yeah.
That doesn't seem very fair.
No.
And then again, like allowing sort of things like they're not being hit with zombie levies. The fourth one is around limiting compensation to the actual capital loss. This is what I was talking about earlier, saying not compensating people for what they should have got, but actually being like, you've lost money, here's your money back.
Yeah, exactly.
And I think that would be the biggest sort of one. So they're talking about also looking at the rate of return used when calculating the sort of position, so limiting that to an actual benchmark. So that could be something like the Consumer Price Index or the 10-year government bond rate. Again, straightforward. The fifth one, I am still scratching my head about. So it's called embedding a special levy waterfall, which creates a 3-tiered waterfall when costs exceed the $20 million cap.
Yeah.
I honestly still do not. I've read this document so much.
We weren't much help, to be fair.
And I talked to multiple people being like, does anyone understand what this is telling us? And as far as I can get it, it's saying basically the structure of it makes sense to me. So it's saying there's 3 tiers. There's like the main principal sector that are responsible for it. There's a second subsector, and then there's everyone else. And they're saying basically we want the special levy, the ones that are going above the normal levies, should kind of filter down and waterfall. But understanding what these caps are is pretty hard. From what I understand, it's $40 million for the principal one, $40 million for the second one, and $30 million for everyone else. But I'm like, why is it $40 million for the principal one and the same?
Yeah. Was the issue that the primary subsector was up to $20 million? Was that it?
So it was $20 million for the normal cap and then $20 million for the special levy.
Yes,
so
yes,
total would be
yeah.
40.
Yeah.
But I was like, why are they paying the same amount?
And this might be a stupid question, but would there always be a connected subsector, or would this?
I don't know. I guess
Yeah.
it depends on what the issue is, really.
Yeah.
But yeah, so for like financial advice firms, for example, I was like, are you saying for this $250 million special levy that is going to have to be found somewhere along the lines that you're only going to charge $40 million to the principal sector? That cannot be what they are saying.
Yeah.
Doesn't seem like an even
honestly, I read it so many
here.
times and I was like, I need someone to talk to me about this because I do not get it. And I've talked to, as I said, probably about 10 different people being like, what is this? What is happening? And no one can give me a clear answer because everyone's reading the same document being like, no idea. It doesn't make any sense. So I would love Daniel Molina or someone in the Treasury maybe to provide a bit more clarity on how that actually works. Because I was reading it and being like, I get it. They're saying, certain years it might be over a cap. We'll have to like flow it on through multiple years to try and recover these costs. But I was like, why? What? Why is it so small? So if anyone would like to read the compensation scheme of last resort consultation and have a look at the special levy waterfall and see if you can make sense of it, please do. I'd love to know what you think. So that was number 5. Number 6 was about the treatment of SMSF losses. So again, this is a big growing sector. Self-managed super funds are saying SMSFs are the primary users of the scheme, but they don't pay the levy. So being like, maybe they should. But then you have the whole argument of being like, should superannuation be included? And what does that look like? So then again, levying managed investment scheme losses as well. So looking at how to apply special levies to the managed investment scheme sector. So potentially looking at a broad-based levy on all schemes or a risk-informed approach that exempts lower risk. And then the final one was recoveries from corporate groups. So looking at where a parent company lets a subsidiary go bust to avoid AFCA determinations, but keeps the profitable part of the business. They're being like, we don't love this idea that they don't have to pay compensation, even though part of the group is still functioning. So let's say you've got a subsidiary and you need to pay loads of compensation to people, they're basically saying it is cheaper for us to let this company go into administration, go bust, so that the compensation scheme of last resort has to pay, we don't. So they're basically kind of offloading liability onto the rest of the finance sector, which obviously the rest of the finance sector is not loving.
No.
For example, personal advice.
Yes.
So, personal financial advice, we're seeing a lot of problems there, and this is where people are complaining because the rest of the finance industry is saying, why should we pay for this? It's not our fault. Look at credit intermediaries. I think currently the levies are kind of based on like ASIC enforcement, and I think for FY26 it's about $1.5 million that credit intermediaries will have to pay in the levy, which is kind of a normal amount. But then if you start going, oh no, we're just going to spread it across the rest of the industry, you're like, that could be tens of millions of dollars, which for an industry that's predominantly sole traders and doesn't make a huge amount of profit, not great.
No.
So
Let's to unpack that.
yeah, that was a big one. And that was one of the 3 consultations. So you know what? You are all welcome that we read it for you. But yes, that took up a lot of my time this week, being like reading through these consultations, trying to make sense of it and trying to put it in a story that wasn't 15,000 words long.
Yeah.
Yeah.
But it's a good thing for our listeners and our readers to know about, I think, as well. And like, obviously it's a well-intentioned scheme, but they've got to sort of tweak with the sides and sort of make sure it's working for the industry.
Yeah.
So,
And the reason why we're writing about it is because they're consulting on it. So if you do want to have your feedback included, you can, I think it's open till the 22nd of May.
Okay.
If you want to provide a response. So, this is why we're writing about it, is in case people are interested and do want to have a say on how the CSLR impacts them, basically. At the end of the day, we're all having to pay it. So there we go. I am tired
Well
just
done.
talking about it. Yeah.
yeah.
Props.
far out, yeah.
Massive props to you.
Yeah, thanks. And yeah, as I say, if anyone has any questions for us about it, please direct them to Treasury. But I think generally there's been quite a bit of news this week, even though it feels like a quieter week than normal.
For an Easter,
Yeah.
the flow on from Easter long weekend, it was pretty lively.
Yeah.
So hopefully that keeps up.
Yeah, and of course you've still got, the ongoing Middle Eastern conflict, so looking at what's happening over there, peace talks supposedly happening, so
And the Reserve Bank and what's happening.
yeah,
with them as
fingers
well.
crossed that will kind of calm things down a little bit if we do get an outcome and the strait is open again and everything is back to what it was pre-conflict, and then maybe Westpac can reverse its second hike call and we'll just have one this year. That would be great because I think, as you say, at the moment, I think Westpac actually this morning put out a statement basically being like, we would love for our forecast to be wrong.
Yeah, I
If
saw that.
If things do calm down, we would be very happy to go back to
I
our
did see
initial one
that.
of just saying a May hike rather than May and June, was it?
It's like, no, we don't want these things to happen.
We don't want
it's
them
like,
to
well, I
happen.
hope
Yeah.
you don't.
So I fingers crossed we'll be keeping an eye out on that too. But if you've got any news for us, do let us know. Reach out. You can reach us at editor@theadvisor.com.au. Of course, all of our email addresses are on our bylines on site as well. And we all leave a comment. We'd love to hear what you're up to if you've got any news for us.
Sure.
Otherwise, and yeah, if you're coming along to Better Business next week, Better Business Summit, Better Business Awards in Melbourne, it'll be taking place next Thursday. Then yeah, make sure you buy your ticket soon because the awards will likely sell out. But looking forward to seeing lots of our listeners there and meeting them. Any nice plans for the weekend, guys?
Pretty low key for me, I think. But yeah, it should be a good weekend. I
Pretty
think I'm ready
low-key.
for it.
It's always nice.
Yeah.
Yeah, I'm going to catch up on some sleep, I think.
Yeah, I think you need it.
Yeah.
I think that's well deserved.
And then recharge your batteries for next week. Yeah, I don't really have any major plans, but looking forward to hopefully what will be a nice weekend. It's going to be 33 degrees apparently today.
Yeah, it's heating up.
Yeah.
Thankfully, our air conditioner's working, which is nice.
Yeah. We hope you guys all have a great weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.